All right, thanks, Jen. Hey, welcome everybody. I appreciate you taking the time, especially given that suddenly the markets are acting nice. And so that's kind of a different tone the last couple of days from where we were simply last Friday, or if you will, Monday morning. It was doom and gloom. And I want to talk about income today, but I think it's important to think about it in the sense of all the noise that there is out there right now, because it's very, very easy to be scared. And it's very hard, or at least much harder, I think, to have people believe that there's a decent future out there. It doesn't have to be perfect, and we all have trials and travails in our personal life that do spill over into how we feel about the world we live in. And I recently had a conversation, well, actually it was yesterday, and it's just similar to so many conversations that you have. It just happened to be two different people, two different clients that had a difficult time separating, if you will, the economy from the market and the market's reactions. And when we think about what's going on in the world today versus what's happened in the markets, we kind of do understand that this is a time that is really, if you will, so uncertain. And so I guess we kind of titled this particular one, the markets can handle uncertainty, or can't handle uncertainty, they can handle difficulty. And we are going to talk about income, as I said, but it's important that we think about all the uncertainty out there. There is so much. I can't think of very many things, like the elections are coming. Are the Democrats making a comeback? Is the House going to change? Which is kind of important in Wall Street mind with, are they going to be able to slow down some of the incredible overreach that there is in banking, finance? The SEC wants all kinds of things, including woke corporations. They want to require, I'm not being funny, this is really true. They want to require that boards have a queer on their board. And I'm not being derogative. They use that term, which is kind of weird. We kind of think of board of directors as the best people or experienced people. And these are the kind of things that, if you will, kind of turns Wall Street on its head. Right or wrong, those are things that are disturbing, add more uncertainty to what's going on. And then we think longer term. The recession. Is there a recession? Are we in one? How deep is it going to be? How high are interest rates going to go? And then the volatility you throw on top of it. It's a very difficult circumstance. Totally get it. The question we always ask ourselves too is this the peak of pessimism? Are we there yet? And that's of course impossible to define, is what the peak of pessimism is, because as soon as you think you're somewhere near, then the market goes down even more and people get even more negative. And then we're maybe even not there yet. Or as we talked about probably 2 months ago, well, it was June, I guess longer ago than that, when the market was in really, again, hitting its lows, we talked about the peak of pessimism then. We had a huge summer rally only to watch it unravel again, which makes it even more heartbreaking as we enter into this time. But one of the things that I want to, again, relate to this past conversations. Jen, can you pull up those slides for us, about where we are with corporations today? And then I'm going to spin this into income. The thing that is what people have a hard time understanding is that dividend yields are going up. They've been going higher. And they've been going higher basically, except for a few years in there, basically for all of our lives. It's really an income story. The greatest corporations in the world are an income story. I know the optics only allow us to think about what the price of, say, Procter & Gamble is, and nobody thinks about the dividend. And the reason I use Procter & Gamble is because, well, they make soap, and they've been around for a long, long time, and they've been around almost 100 years before. Let's say you owned it in 1970, it was paying 1 penny per share per quarter. It's now 80 cents per share per quarter. And it's not because they invented new soap. It's because they have, whatever, the 20th revision or upgrade of Tide. And now they put Tide in pods or whatever it is. I'm sorry, I'm not very good about laundry types of things, but you get the point. It's not high tech. It's not high tech. That's just one company. The S&P 500 is pretty darn good at it. And when we think about the market today, and this is where you have that difficulty, what's the market doing? Why is it down 25%? Well, of course it's down 25%, but what happens if we have a recession? Okay. This right here is where we are right now. The S&P 500 just paid out a record $140 billion in dividends. That beat the record from the prior quarter and is now up almost 14% from the first quarter of 2021. It's a lot. Corporations are returning a lot of income. Corporate balance sheets are flush. They've never had more cash on their balance sheet. Profits, which are about to be announced this quarter, drum roll please, will be at all-time highs again. The first quarter all-time highs, second quarter all-time highs corporate profit, third quarter will be. Why is the market down 25%? And this is where we have that disconnect. Markets are thinking forward, okay? They're thinking about what's coming. Right or wrong, they're predicting the future. And so we get in these circumstances where we just don't fully embrace, fully understand that right now, it's never been better. So why wouldn't companies be at all-time highs today? Because they're predicting more dire times, more difficult times. But now may I add, the uncertainty is layered on top of that. How bad could it get? How good is the geopolitical situation? How is our feeling about our leaders, both here and abroad? It's not good. Consumer confidence, all-time lows. But what I'm saying is with the market moving ahead, nobody's arguing there won't be a recession, but the idea that people are out there beating the drum constantly on the dark web, on dark TV, what's light about TV, right? Unless you're watching an old Disney flick or something. Seriously, what news did you pour into yourself today that had anything, I mean anything good to say about the world? They might have slipped in a picture of a kitty being rescued during the Great Flood. I don't know, but that's it. That's all they ever do. Do they ever talk about the fact that corporations have all-time high earnings, all-time high profits, the great job market we have out there? Nobody ever talk about that. And it's always easy to sell fear. So where do you think people who are selling stuff go? They go to the dark side. Always and forever. I can't say this enough. I know you've heard me say it a zillion times. Stay off the web and don't go down rabbit holes. To me, it just makes no sense. I mean, none at all. I'm just getting information. No, you're not. You're getting financial pornography. You can't possibly make a good decision. You can't. It's just crazy. It's really crazy. So as we think about all those things piling in and all the negativity, what happened yesterday? The market explodes higher. Who predicted that? Certainly not Jim Cramer bouncing around on TV, going like this on Monday and Friday, and oh my gosh, it's not going to get better. It's just it. And then it goes up even more today. I'm not saying it's up and away. I'm saying when we feel like that, don't react. We have to. Got to stop ourselves from doing that. So let me talk about this from an income perspective as well. I just kind of tipped our hat on how much corporations are paying. But let's kind of break that down. What does that really mean? Okay. So when we say that it's okay for the market to have a correction, I know you don't think so. I know you hate them. I know you knew they were coming, but was it really going to be this bad? And why couldn't we step aside? And am I going to run out of money? Is the question you ask every time, because we all do. We all do. And so as we look at it, and we see all of these, if you will, dividends of these different corporations, let's just kind of round it off and say, hey, do you know that the market's down 20%? And so as a basket, without being precise, these stocks, which many of you own, just a snapshot of some of our income portfolios, frankly, okay? This is a snapshot of those companies. And 20% ago, so if JP Morgan, just to give you an idea, was trading, and it was even worse than this for JP Morgan, but if it was trading at 120-ish a year ago, it's now trading around 100-ish now. And it might be more like 135 and 110. You get the point. It's down 20%. But how is its income? It's up 11%. Now, if we were to honestly say this, if we were to say, I have a building that provides more income by 11% this year than last year, net of all costs, would I like that? Would I sell it because somebody told me it's down 20%? Of course you wouldn't. That'd be absurd. Why would you sell it when it's actually worth more, 11% more, than it was a year ago? Now, sometimes people don't understand dividends, so I can see why Jennifer's flipping us back here real quick to help you understand. Price does not affect the dividend paid. All right, so follow this for a second. Here's why you think it does. If we have this much money in the bank or this much money in the bank, which one pays more? Obviously, this one does, because it's just based on how much money you have in there times whatever interest rate they're paying. That's it. Stocks don't work that way at all. Neither do bonds. But let's stick with stocks, okay? I just want to stick with that. So what happens here is we look at, let's say we have 500 shares of a stock. And of course, this is a real company, it doesn't matter who, and what their dividends were coming in, because it's paid per share. So as you see, you pay 70 cents per share per quarter, $350. Even though on the other side of the screen, the price is $56, as high as $69. I know, should have sold it then, bought it back on the dead low the day, when it's at 51 bucks, and then done that over and over again because everybody's that good. But you see what I'm getting at? It's still 70 cents, 350 bucks, same price. Or same value, I should say, very different price. Okay? So that's how and why, as we shift back to be thinking about all of these stocks, and why if we get a down market like this, it really doesn't matter to a stream of income. It really doesn't. Income's going up. It's going up, even though your prices are going down. I know it's tough, because all we know is if you sold out today, you're down 20%. So as we look at all of these companies and you see that they're all raising their value to you, the income, how do we shift our optics off of that? Now, one of the things I always tell people when they say, well, what do you think is going to happen? I don't really know. And that's not false humility. It's just not. It's the only thing you can ever say that's real. We don't know what the future is going to be. We think we get a few tidbits out there, learn a few things, listen into a little bit of news, and if we're really super smart, we dig in on the web and we find some people that know you ought to buy gold, and they talk about currencies and how the US dollar is keeping gold back, but the world's coming to an end, so pretty soon gold's going to go to the moon. Heard that for 40 years. 40 years. It's a long time. And so as we talk about that, again, I make fun of it, of course, but remember, gold doesn't pay anything. There's no income to it, let alone becoming more productive and raising the income over time. Just doesn't ever do that. So as we think about what we're trying to do every single year, and we think about income, we're always thinking about it from a standpoint of where are you going to be in 3 to 5 years? Why? Why so far away? We already know where the income's coming from for the next couple of years. That's automatic. And in many cases, most cases, it's simply nowadays with dividends coming in, it's coming into your reservoir on a consistent basis, meaning you don't just drain it out by, let's say, the $3,000 a month you take out every month. It doesn't just drain out and then we replenish it. It's constantly coming in, right? Interest and dividends are coming into the portfolio on a regular basis. Typically 60, now we're getting closer to 100% because interest rates, dividend yields have come up, okay? So it's even getting better. So we don't have to have a lot in reserve, but that's what we're thinking about 3 to 5 years out. Why? Because we expect the market to correct over and over again all the days of your life. That's exactly what's going to happen. Over and over again, all the days of your life, you'll have market corrections. We just don't know when. So when do you think the next correction is going to be? I don't know, but I know we'll have one. I also know, but I can't guarantee, and past performance is no indication of the future, except for 300 years, the market has gone to all-time highs. It has corrections, goes back to all-time highs. Corrections, goes back to all-time highs. I love statistics like 52% of the days are up, meaning we have to suffer through almost half. I mean, virtually half of the days are down. And those days sometimes appear to be a little bit worse. Well, if you really focus in and look with a microscope, right, you'll find that they really are. You're absolutely right. By 0.03%, although I don't think the human eye could do it without a microscope. It's very fractional. It just feels that way because losses are worse by multiples than gains in how we feel. Like, wow, I made $100,000 today. Oh, man, is it depressing to lose $100,000. It's just not the same. It's not close to the same, behavioral psychologists say. And I would certainly say, without having a behavioral psychologist degree, I certainly concur with that. That's absolutely true of every human being I've ever met. Okay? It's tough. It's illogical that losses would feel way worse than gains, but they do. It's why this game is so emotional, psychological. It's about controlling ourselves. But I have these conversations all the time, and the only way I can say this is this: if we are at the best times, why is the market not at the best times? Well, it's because of interest rates. It's because of inflation. It's because of no. I mean, if the economy currently is a reflection of the market currently, why is it not at all-time highs? Because I already said it, right? All-time high earnings, dividends, all that. It should be, because we're looking ahead. So the only argument and the only concern you should have about a recession is how severe, and not precisely when. Like it's going to happen we think in the second quarter of 23. Oh, good for you. And you thought it would actually happen in the second quarter of 21 and 22. And that's great, because economists are always wrong. We don't care about the precision. We care about the direction. And to state it another way, if the Dow Jones Industrial Average is going to go to 1 million, and it will, I just want to get money in front of that when there are bargains. Okay? So 1 million, yeah, right. Like I'm going to live that long. Doesn't matter. It's the direction. If it goes to 100,000, when's that going to happen? Probably in our lifetimes. I know, maybe not all of our lifetimes collectively, because, well, some of us, A, might be old enough that won't work. B, others might get sick. It's just a function of numbers and direction of what we're trying to do. Get in front when prices are good. We all say that in the abstract, but it's very difficult to operate when we have such uncertainty. So what I would say with the market, if you want any kind of deliverance of peace about the market, number one, you really have to dial back the information. I know some people have gotten really good about it. They've taken that burden of trying to figure everything out, given it away. In some aspect, whether, for the finances, they've given it to us. In other aspects, it's like, I can't figure this thing out either. I can't figure out that. I don't want to deal with it anymore. They give it over. They give it over to professionals, they give it over to their spiritual selves. It's a marvelous thing to find peace in a very unpeaceful world. And so part of that is trying to understand that we're just trying to get in front of the direction here. If the stock market, the greatest corporations in the world that raise their dividends consistently, is the greatest income story, I just want to own them and own more of them when prices go down. I don't want to run from them. And if we have an opportunity, even in an income portfolio, and you do, we will flick the switch and reinvest some of those dividends back in. So you get more shares at lower prices, compounds quicker, and adds more security long-term for the income story. You can do that when we're thinking out 3 to 5 years. When there's enough money, we don't need every dime to come in. Some of it can be reinvested, and we do. You'll see that in your statements. It also means that there's things out there like structured notes, structured exchange traded funds. These are things that I know I'm not getting in the weeds, but I want to mention them because you're seeing them in your portfolios. They become incredible bargains when we get into volatile periods of time. We don't tend to do them. I don't think we did any of them in 2021. I doubt we did any in second half of 20. It's just when we get in times like this, then we get excess premiums in some of those income portfolios with what's called option writing. And those are available in ETFs also. You don't have to see these things. You don't have to know much about them, but understand that's what you do in times like this. You don't run. You don't, well, should we be safe and no, this is when bargains are. And it's not a question of, I don't want to take risk. Of course you don't. Of course you don't. But we can't take it out, earn little or nothing on it, and draw an income and think it's going to work out. It won't. It just won't. And so feeling good about, I feel such a relief to get out is not understanding that, well, you can't. You can't leave now. This is not the time, especially if you're in an income portfolio, because where are you going to go? Well, I'll just pull it out. Again, back to a conversation yesterday. I'll just pull it out because it's going to get worse, and then we can come back in, when the market's doing better. Here's the problem. 2009 is a classic example. You'll think this is crazy. Well, that's just 2009. But 2009, for no reason, the market turns around, heads higher. As unemployment rate skyrockets, healthcare is taken over by the government, 20% of the economy. You may think that's a great idea. Trust me, businesses didn't, okay? So that's what we're talking about, is in the economy, businesses, okay? So that is what is talked about, what is happening. Oh, I forgot to throw in the best thing possible for the economy, raising taxes and raising regulations. I forgot all about that. So we have all of those factors in full-blown effect now, and we get to watch those economic numbers. 8% employment, 9%, over 10. Seriously, all the way through the summer. This market from March 9th till 45 days, 90 days later was up 45%. Why? It's looking forward. And all we're hearing is the drumbeat of news that actually occurred yesterday or today, anyway, moments ago or days ago. And that's how human beings sometimes react. That's, of course, absurd. But that happens to be the average of what happens out of bear markets. Right on the average, 40 to 50% gains in the first 90 days. It's incredible out of a bear market. So that's why you see days like this in the midst of the horror this is. We've shown you this chart to death, so I'm not going to show you today, about missing out on the best 10 days, 20 days. For the last 20 years, you get no returns. They just go away. And the second part of that is that they occur typically right next to the worst days. Nobody could trade in and out like that. Nobody on Friday was going, I got a position long because I think we're going to have 2 of the best days of the year. No, nobody did. Nobody did. Things look obvious in hindsight. They never are. They never really are in time. Well, 2008, I saw that coming. No, you didn't. I saw this coming. No. You saw troubles with Joe or whatever it was, inflation, all those things. But inflation didn't really tick up much until it just caught hold. Which is why this is not bragging, because if we were bragging, we'd say, well, yeah, we have 50% of the portfolio in cash. No, we entered this year with the maximum amount of cash we've ever had in our income portfolios. Why? Well, we got lucky. One, we had the highest year-end distributions ever, okay? And the second part, why not? Why reinvest it right away when people are going to need it and it's at all-time highs, and all-time highs by a lot, right? It just kept going. That's not guessing the market's going to turn around. That's the preparation I'm talking about. That's the money we know is going to be needed in the next couple of years. And now we're covered for the next 3 to 5 years. And structured notes that have some downside protection, that helps us there too. So we can be invested and not worry about a prolonged bear market, because that's the next question I get all the time. Yeah, but this one, it's not usually a question, it's a statement. Yeah, well, I was around, or I've been reading about, I know all about the hyperinflation 1970s. I know all about Jimmy Carter and his 21% interest rates. I don't want any part of that, and that's what we're going into now. It's not a question. It usually, then in the end, they'll usually go, do you think that? Well, I don't. But thank you for asking, or pretending to ask, or pretending to care. It's just people get wound in this because fear overrides our thought processes. I don't know what's going to happen. Maybe we are. I just don't happen to think so. And there doesn't seem to be any evidence that we're entering into a hyperinflation period. Are we entering into a slowdown? Did our policies put us in a really bad position? They did. There's no question about it. Nobody denies it. This is not a political statement. Nobody denies that the policies have ignited inflation. Nobody. That the Fed also, on top of that, is printing too much money, has been printing too much money, really blew it. Nobody denies that. The Fed, though, didn't just keep doing it, they stopped. Now they're pounding the economy. So things are kind of changing. So I guess my message today is this. Your income is up from 12 months ago, even though price is down. I got an email because I made that same statement on Saturday's radio program. And I got an email from somebody, not a client, just said, I just wanted to thank you because after I ran my own numbers, I found I was up 6% from a year ago on my income. You were right. I feel much better now. So it's not to make you, pat you on the head, make you feel all better. That's just to say that that's the focus, best we can in a very noisy, crowded world, looking for your eyeballs, looking for your energy, emotion, and trying to get you to come in and drive you in deeper so you'll buy some products from us, or at least your eyeballs will be viewing for us to sell ads. But that's not going to help you have peace in this world at all. Now, I said this the other day to some of you, but all the rest, I want you to understand this. We communicate all the time. Radio for 35 plus years. Now we're Zooming, YouTubing, occasionally sending a link out, in addition to client events that we do. But it may not be what you're doing. I just saw this, we saw the analytics on this. People have downloaded the radio program 40,000 times. That's a lot, but that may not be you. If we're not communicating in the way that works for you, you need to let us know so we can communicate with you. I know you don't need any communication when times are grand, but when times are a little bit rough, and they are, we know you need to be communicated with. We understand it. We're human beings too. So make sure that we're doing what we need to do to help you communicate. And if I just told you about something that you didn't know, that you want to know about, you also need to communicate that to us as well. Okay, Jen, did I miss anything here?
Well, you just had that one slide you wanted to talk about, but I don't know if you even want to go back to it now with the S&P valuations, or you want to just move on.
No, let's move on. I don't want to talk about that. That's another rabbit hole. I'll dive down.
And we
always try to keep it at 30 minutes. So here we go.
Perfect.
Okay?
Yeah, but we do have a question already, so we'll just go there.
Good.
How's that?
Let's do that. Let's open up.
You bet. What happens in the market if we end up at war?
Again, it depends what kind of war. Obviously, there's a big difference between nuclear war and us sending some hardware over and pretending there isn't a war over there. That doesn't really affect us, does it? I don't know. It's a difficult thing other than to say, of course, it's the severity. The severity could be from horrendous, right? I mean, obviously, if nukes are launched, this is a horrendous change in the world, right? And of course, we can argue all day long. I've heard generals talk about, there's just no way Putin's going to do it because he knows we'll annihilate his entire army in a conventional way. But we're dealing with people who are crazy. I mean, Little Rocket Man just launched something last night over Tokyo. I mean, he has no capacity to feed his own people, let alone fight a war. But there's crazy people in this world. And I'm not even talking about the terrorists that can unleash hell on anything. So it's a dangerous world always. I just don't know how to manage around, if you will, nuclear war, or the end of the world, or however we want to see it. And obviously, if we literally start launching ballistic missiles at each other, the world will end, and cockroaches and a few people that have bunkers will be all that's left.
Any other questions? Again, feel free to put it in the chat window, raise your hand. Anyone at all have anything to ask? Well, I guess less questions when the market had a couple good days, right?
It always is. I know,
Yeah.
I know.
Yeah.
I know we feel better about it the last couple of days.
Yes, we do.
Yeah,
Absolutely.
no doubt about it. And it also gave us an opportunity. I'll tell you, if you want a little bit of a, transparency into what we do, I will tell you, we did a lot of trading the last couple of days, and we have over the last this summer, not a lot by people who trade all the time standards, but we've done a lot, especially in the income accounts, because we need to make some changes to make sure there's plenty of income out there, because it can always get worse, always. And running out of money is not an option.
So I'm going to ask you a question since there's none out there. I know that recently we did decide to get rid of emerging markets. Did you want to touch on that at all about why, and maybe give an overview?
Sure. Yeah, there's a couple things. We had a long run, probably 20 years, where emerging markets actually outperformed the U.S. market very substantially, but that was a long time ago. And whenever they pull back different sectors, if you're a value investor, and I kind of, it's like, yeah, we are, but who isn't, right? It's not like somebody goes, I'm going to try to find some of the most overpriced stuff and then buy it and just hope it goes higher. That's everybody's a value. It doesn't mean you don't own Google and Amazon and good growth companies, but we're always looking for value. And then when sectors or, like emerging markets and things like that fall, then it's something that gets our attention. And it always did, because of the emerging middle class and all that. And I don't want to go into all the weeds, but it's a great story, and we try to keep up on it and study it and all. But something happened on the way to democracy, Never Land, okay? All of a sudden, around the world, what's popped up is bad guy China instead of the free market China. Okay, and what happens in places like Venezuela over the last 20 years? They devolve into chaos from wealth and democracy. Chile struggles. Argentina flops and flounders. We all know all the basket cases all through Central America and how difficult that is. And then you throw Russia on top of China. I just don't. What are you going to do in emerging markets now? Buy Taiwan Semiconductor, which is what they all kind of go to. That's the biggest holding in every emerging market fund that I know of, with the knowledge that China wants to just take them over. And I don't want one holding. So we finally went, yeah, until the world changes again, and it might be 5 years, 10 years, who knows? And I don't mean getting cheaper. I need to also have a catalyst that says this is a story like the emerging middle class was. But the emerging middle class with dictators is not an emerging middle class anymore. It's an economy that can't and won't work. It's why, this isn't political, it's a fact. The bigger governments get, the worse the economy gets, always in all ways, because government is dysfunctional. And so the more centralized it is, which a dictator is the most centralized, the more dysfunctional it is, because the people out there like you and I have no freedom to go create stuff and figure out the very best iPhone in the whole wide world and all those other amazing things that we get to use, because we don't have the freedom to do it. And government can't dictate that. They never can, they never do. And so that's what's happened in these countries from moving this direction to now centralizing again. And that has to change for me to get excited about emerging markets. Good question, Jen.
Good, good. And this is a great question too. On a previous Zoom, you mentioned some real estate investment opportunities for spare cash. What other opportunities are available?
Okay, great question. All right, now that interest rates have changed, you're going to be seeing this from time to time. Again, you're not going to see a lot of cash in a portfolio because cash is earning near zero, okay? So we don't want to do that. We want to have cash, or as we call it, cash-like. And you're going to see that in exchange ultra short duration ETFs. That's great. Isn't that great? Now, nobody knows what I'm talking about. So let me go ahead and pull back and just say all that really is cash-like. It's very, very short-term bonds. And you've all heard the 2-year treasury, 5-year, 10-year. You've heard all those terms, inverted yield curve. That means we're never said all those really everybody knows the future because all you got to do is draw charts and squiggles and you'll figure it out. Not true, but you will hear through all that rambling that the 2-year, 5-year, all that short-term paper rates are up. We even have, I think Dad just did a CD ladder for a year, right? Somebody just wanted some money over the next year, 3 months, 6 months, and so on. And every piece of paper in there, except 3 months, was over 3. It was 2.9. That's interesting to me. We would rather do things like that, but the easiest way is in an ultra short duration because it's buying all of those things, and we can sell it any business day, and then we turn it around and put it back in a portfolio if we need to feed it. So those are the kind of things that you're going to be seeing and already are seeing in your portfolio. ETFs, mutual funds that are earning 3, I would call it probably 3.5 because rates have come up, and the numbers we get are trailing 30 days. So that's just saying that we think it's around 3.5 now that people are getting on these ultra short things. And that's pretty good compared to 0. It's not great, but it's something on our reservoir money. So you're gonna see more of that too.
And can you touch on I-bonds? Because everybody asks about those too.
Okay, I will touch on I-bonds again. This is something you have to do on your own. Number one, go to Treasury Direct. If you don't know where that is, call our office. We'll send you a link. It'll take you right to it. You have to link up your bank account, and you can do that. And everybody should put $10,000, at least right now, per year, and probably again in January, because inflation is super high now, but you're limited to $10,000. We can't do it for you, or we'd have done it all day long for you, for everybody. But again, it's just something you have to do on your own. Link up your bank, put 10,000 in per person. Okay, so you all who are married can do $20,000, and that is something that's right now earning over 9% because inflation is so high. There are some drawbacks. They're pretty simple. I don't think we need to go into all the details, but you got to keep it 5 years to get the full benefit of it, and so otherwise it's interest penalties, and inflation is not going to come down overnight. But be aware, it probably isn't something you hold the rest of your life.
Good. All right. Any other questions? I don't see any.
All right. Any comments, Jen?
No, I think we're good. I think you
All
covered
right.
everything that I can think of.
All right. Folks, if you have an idea for us, we want to hear from you about what you want us to talk about. We're just trying to figure out how to communicate best we can with you. And if this isn't a convenient time, then we tried some in the morning and so on. Those are on our YouTube channel. You can subscribe there, get alerts. So if you miss one, it'll tell you there's one out there. Okay? Have a great rest of the day. We'll talk to you soon.